Next, let's talk about UPREITs. If you ever thought about selling a rental property, you probably ran into a problem of capital gains taxes and depreciation recapture. An UPREIT offers a clever solution for landlords who may no longer want to directly own real estate. UPREIT stands for Umbrella Partnership Real Estate Investment Trust, and here's how it works. Instead of selling your property and paying taxes, you can contribute it into the UPREIT in exchange for operating partnership units. The advantage is that you're not triggering capital gains taxes when you do this. The REIT then becomes the general partner and manages the property. You even have the option of converting the partnership units into REIT shares. However, this would trigger a taxable event, but you would be swapping your property for a slice of a much larger real estate portfolio, one that's managed professionally and often diversified across multiple property types and locations. However, there are trade-offs to UPREITs. First, you give up control. You can't decide when properties are sold or how they're managed. If the REIT sells your property, you may recognize taxable gains even if you personally didn't choose to sell it. And unlike direct property ownership, you can't 1031 exchange once you convert your partnership units for shares in the REIT. Another potential drawback is that in order to get this process started, the REIT has to actually want the property that you're contributing. You may have to contact a number of REITs until you find one that's willing to accept it.